everyone, and welcome to today's Explainer. Today, we're unpacking one of the absolute most fascinating market anomalies we've seen recently. We're going to look at a tale of two very different trading days, July 6th and July 7th, and uncover this incredibly strange options pricing anomaly that printed on the 7th. Okay, let's dive into this, because what looks like an intimidating scatterplot of data actually tells a beautifully simple, highly mechanical story once you know exactly where to look. Think of today's explainer as a financial mystery just waiting to be solved. Often, market data behaves predictably. The numbers stay right in their lanes, the curves look totally normal, and everybody goes home happy. But on July 7th, the options chain did something wild. It stretched out, it bubbled up, and it threw up some major red flags that literally left a lot of traders scratching their heads. So what were these numbers actually telling us beneath the surface? Section 1. Decoding Delta versus IV. To make sense of an options curve, you need a reliable x-axis. Using delta as our practical stand-in for moneyness, we plotted against implied volatility, or IV, to see exactly how the market is pricing risk across different strike prices. Now, if markets were perfectly clean and operated exactly like a textbook, volatility would be completely flat across all strikes. Delta wouldn't correlate with IV in any interesting way whatsoever, but real markets, yeah, they never actually look like that. What you get in the real world is a skew. Out-of-the-money options naturally trade at a volatility premium. Plotting delta against IV is just a highly clever way to see that skew directly. So the crucial point is that this out-of-the-money premium is exactly where the market hides its true feelings and its true positioning. Section 2. The call curve stretch. July 6th versus July 7th. There is just a stark contrast between these two sessions. On July 6th, the call curve was tight. It had this compact, orderly, textbook kind of shape. The implied volatility steadily climbed from roughly 6% up to 18% as delta dropped. But then we look at July 7th, and the curve just stretches way out. I mean, the IV range essentially doubled. It didn't even start dropping until IV was already around 10%, and it didn't bottom out until IV hit a whopping 35%. That is a massive expansion in just 24 hours. Section 3. Spotting speculative positioning. Now, what's really interesting here is exactly where those data bubbles decided to show up. Way out at a delta of about 0.65 to 0.70, sitting way up at the 27 to 32% IV mark, the data suddenly swelled. These weren't just slight bumps in the curve, guys. These were distinct, heavy anomalies sitting far out on the wings of the options chain. So what is the actual anatomy of these bubbles? Well, bubble's size represents open interest. When you get a massive bubble out at that 0.65 to 0.70 delta mark, it's a glaring signal that there is serious, large, real money size sitting out there. These traders were positioned far out of the money, and they were willing to pay a huge volatility premium just to be there. Make no mistake, this isn't your everyday hedging. This is massive, highly speculative positioning, and it was anything but small. Section 4. The put asymmetry. When we compare the shapes of the two curves on July 7th, a glaring detail emerges. It's the slope that actually matters for the whole story. The call curve takes this long, gradual stretch, dragging from 10% all the way to 35% IV just to move through its full delta range. The put curve, however, it compresses more of its move into a much tighter IV band. It moves incredibly fast. Essentially, puts were carrying significantly more IV per unit of delta than the calls were. Let's translate that technical asymmetry into plain English. The market is saying, through cold hard numbers, that downside protection is priced much richer than equivalent upside exposure. This steep put slope is the actual quantitative fingerprint of skew. What you are looking at is market fear, literally written straight into the option chain. Section 5. The gamma expiry squeeze. So here is the ultimate twist in our mystery. The broader index actually closed down on July 7th. Normally, you'd expect puts to fatten up on a down day as people panic and rush for protection. But as we just saw, the call side got incredibly expensive too. So why on earth would upside bets become dramatically more expensive while the underlying asset is actually falling in value? Well, the answer lies right in the plumbing of the market itself. And this brilliantly illustrates how mechanics can override sentiment. Earlier in the day, the put-call ratio showed put positioning building up aggressively midday. As the market dropped, the spot price sharply crossed the at-the-money strike late in the session. This forced dealers to hedge hard and fast. In those frantic final hours, gamma and implied volatility tend to get violently squeezed together, completely regardless of which direction the spot price is actually moving. The system essentially chokes on its own hedging requirements. You know, this quote perfectly captures the core lesson of that July 7th anomaly. It's so tempting to look at those massive, expensive call bubbles and think, wow, someone knows something. The market is secretly incredibly bullish. But actually, scratch that. That would be dead wrong. The call side richness wasn't a genuine bullish signal at all. It was merely an expiry artifact, a purely mechanical consequence of dealers desperately scrambling to balance their books into the close. So, the ultimate takeaway for your own analysis: never read an option swing in isolation. A stretched curve or a fat bubble, it only tells half the story. You absolutely have to look at the other side, compare the slopes, and most importantly, understand the calendar. Which leaves us with one final provocative question to confirm our entire mechanical theory. Was July 7th actually the weekly expiry? I highly encourage you to go pull up a 2023 calendar and see for yourself. Thanks for joining me for this explainer, and as always, keep questioning the data.